Hey guys, Holly Haven here with Haven Home Team, and I wanted to sit down and chat with Josh Waters today with CrossCountry Mortgage. Josh, how you doing, first of all?
I'm awesome, Holly. How you doing?
Good, good. So what I'm hoping to chat with you about today is really give some of our buyers an idea of how they can competitively purchase in this market, I guess. Right? We've had higher interest rate than we've seen for the last 20 years on average, and it feels a little painful. And I know we spend a lot of time really educating our buyers on how to make not only strong offers, but offers that really work for the buyer. So traditionally, buyers come in, they want the best deal, right? So most buyers think the best deal is to get the house for the least amount of money possible.
Right.
So we've been kind of going through this process of really coaching our clients on it's not always about the least amount of money on that offer. Maybe it is about a lower interest rate, or there's some other negotiations in the contract that we can, obviously educate them on. So I want to chat with you a little bit today just about really those buyer purchasing power. What can we do? What can you offer to really put our buyers in a better position when they're, shopping not only home to home and kind of comparing pricing, but really looking at this interest rate, kind of trying to get our head wrapped around what our monthly payment's going to look like, how we're going to afford it, and how we can really put them in the best position, not just for today, but for 2, 3, 5, 10 years down the road.
I'm with you. Holly, those are all really great points and really accurate pain points that everyone's seeing right now. Everyone talking about rates. It's the number one hot topic and hot button item, especially here in North Dallas or North Texas, where we're struggling with inventory. Right, it's one of the biggest things that's out there. But rates continue to be like the number one stress point, because at the end of the day, that affects how much they can spend on a monthly basis, and let's be honest, not just be living paycheck to paycheck, and because they're in a house. So how exactly can we combat something like that? Well, obviously getting a lower interest rate in the market that we're in right now. It's not last year. Let's put it that way, right? It's not 3% rates, 2%. I mean, heck, even if you mentioned 4 last year, people look at you like you were crazy.
I know, those were fun.
It was. I mean, it was a lot of fun. But what also happened is you also had a lot of people out there buying houses for crazy amounts over asking. And you had so many people and so many buyers flooding the market that it was really, really tough to get an offer accepted. So you start weighing out different options. Okay, well, on one hand, there's not as many people in the market buying, right? Because that's what we're talking about right now is how do we combat like the higher rates? Well, that's why people aren't out there and they're sitting on the couch and they're waiting for rates to come back down. Well, at the same time, with rates being up where they're at right now, which in the forecast we're probably not going to see until probably they'll start loosening a little bit after the first of the year, but also at the same time, you're going to have a lot more buyers coming out once rates really start to even just get a hair better. We saw that earlier. You remember earlier this year in February? Like there was a week where rates went down like 0.25%, and sales just like skyrocketed during that point.
Yeah. And I think it's the natural inclination, you're looking at your finances, you're saying, gosh, I used to be able to afford 700,000. Now with interest rates, I can only afford 600,000, right? Because that might be the offset in their monthly payment. So the natural inclination is I'm going to wait until rates come down. And I feel like I've kind of been beating this dead horse for the last year of guys, do not wait till the rates come down, right? We did this whole date the rate, buy the house, right? Whatever.
Yeah, everybody was saying it, right?
Yeah, what was it? It was annoying. So
it was marry the house, date the rate.
There you go, date the rate. So kind of stupid, but it was really the impact of that message was your interest rate doesn't have to be forever. It can be for now. And if we wait for those rates to come down, then you're doing what all the other buyers are doing. And the natural inclination is just to wait. Rates drop. Everybody floods the market again. And now we're competing and we're paying higher prices, where right now our buyers could actually be in a winning situation where we're getting a little bit better deals on house, prices, contract prices than we've seen over the last 3 years for sure. Yeah. A little bit more flexibility, a little more negotiating. We're actually having, sellers accept contingency offers, which wasn't even, a word. It was like a bad word for 3 years.
You even said that you had to take your dog for a walk and that thing was out the door. There was no way you were getting a contract accepted with any kind of contingencies whatsoever.
Yeah, nothing at all. And so really trying to get, not trying to get buyers to understay, but really trying to put our buyers in a position of being really competitive and being able to buy down that rate, get a better payment, get that lower price, have less competition. It feels a little counterintuitive to buyers right now because the interest rates are high. So really, I would love to give them some options, what you guys can offer, just to kind of help put them in a better place. How do we even explain a rate buy down? And is a rate buy down the best option? Are there other options? I mean, I'm not even pretend to be the expert there. I'm not.
No, you know a lot about what you're talking about, Holly. And honestly, like I wish there was more agents out there that were in tune with the market the way that you are. But you're absolutely right, because the number one way how we attack that pain point of what the rate is we start talking about different buy down options. Now there's two different types of buy down options. There's a permanent buy down and there's a temporary buy down. Conventional thinking back a year or two ago or whatnot, when there was a lot of people in the market, if you wanted to get in like the low twos or something like that, you had the option to buy your interest rate down permanently. And especially if that was going to be a house you were going to be in for a very long time, that was a viable option. Now, in this market, on the other hand, doing a permanent buy down is not really the best play, in my opinion, of course. Okay. Reason being is most folks that are buying houses right now are going to refinance that house within probably the next 12 to 18 months. It's just a fact, right? Because no one's going to want to be in a 6-7%, sometimes higher, depending on their credit profile. No one's going to want to be in that rate long term. So the whole idea, and you mentioned marry the house, date the rate, even though it was kind of like a catchy thing that everyone latched onto for a long time, it's pretty accurate, because right now with the amount of buyers that are out there being so low and rates being up, and that's why, you're going to get an opportunity to get a house for a better deal. Not to say they're going to start reducing prices like crazy. That's not what I'm saying. What I'm saying is every year, especially here in North Texas, and with the annual appreciation rate, we're like on the low end, 4 or 5%.
Yeah, I actually did a video on this probably 6 months ago or longer now, but our average has been 6 to 7% year over year. Mm-hmm. That was not including this crazy COVID time.
Right. Exactly. Yeah. I mean, and we talk about COVID, that number was pretty much doubled, as far as appreciation. But if you look at what those numbers actually mean, and you did a comparison, I did the math recently, and I don't have it in front of me, but I'm happy to share it with whoever wants to, contact us on this.
Don't drop a comment. We'll get it to you.
Oh yeah, just drop a comment and we'll share all that stuff with you, and we'll get in contact and give you the comparison. But I did the math on it. Even on the low end of that 4 and 5% appreciation, if you waited, how much more that house is going to be next year compared to what your payment is now with a slightly higher interest rate? You're losing money by waiting, for sure, every single time, because not only is the appreciation going to go up, the second more buyers get in the market, guess what? Now you're competing, and now we're getting over asking.
Right.
So it's kind of a lose-lose situation if you wait, where on an interest rate perspective, if you buy now, you're going to refinance your house anyway, so it doesn't really matter. But the other option I talked about with a temporary buy down is a lot of sellers are actually willing to pay for a temporary buy down. Most people are really unclear about what a temporary buy down means. Their brain's thinking it's an adjustable rate mortgage.
Right.
And
we go back to 15, 20 years ago when those were normal.
Right. And on the surface, it looks a lot like that. And the way that I like to describe it is a temporary buy down is they come in a few different options. You have, and I'll just rattle off some terms. You have like a 3-2-1, a 2-1, and a 1-1. Actually, a 1-0, better yet. And what those numbers actually mean is, a 3-2-1, your first year that you have the mortgage. Say today's rate is 7%. For your first year, your payment is based off of 4%. That's like 3% lower, right? Your second year is based off of 5%, 2% lower. And your third year, it's 6%. That represents the 1 on a 3-2-1. And after that, your rate becomes fixed at 7% for the life of that loan. What's 3 years you have to refinance your house?
Right.
Okay. What's really cool about it, and then most people don't understand, it's not really described accurately, is the cost to do something like that. It's not technically a fee. It's you're taking that money, it's prepaid interest, you're prepaying your interest on that house, on that rate for that time period. So let's just say we're looking at a roughly $500,000 house, and then a 3-2-1 costs right around $19,000 or so, depending on what it is. I like a 2-1 better because I think that people are going to refi before that anyway.
Yeah.
It's a little bit cheaper too.
Okay, so on a $500,000 house, what would a 2-1 look like?
Oh, because on a 2-1 buy down, it costs about $14,000 ish, right? Because all you're doing is whatever the difference in payment is between a 2% difference in payment for that first 12 months and then 1%. All it is simple math. It's not, there's no additional things on top of it. It's really just a difference in payment on your principal and interest.
Okay.
So that money that it costs to do something like that, again, it's not a fee. It goes into, we'll call it like almost like an escrow account, like when you pay your taxes and your insurance. It goes into here, and then us as your lender, we pay the remaining part of that payment for you every month out of that account.
Okay.
And a lot like your escrow account, when you go to refinance your house for your taxes and insurance, anything that's left in that fund, you have the option to have that refunded back to you.
Right.
Whereas a permanent one, if you spent $15,000 today on a permanent buy down and you refinance your house in 12 months,
you don't get it.
That money's gone.
Right.
That's why I don't like permanents right now.
Yeah. Yeah.
Does that make sense?
Yeah, absolutely. So the cool thing really about this is we do expect interest rates to come down early next year. Now, what that looks like and for how long, right? My crystal ball is broken. I'm assuming yours is too.
Mine is definitely broken. It's been kicked around the office quite a bit. But yeah, the Mortgage Bankers Association, so they actually project by the fourth quarter of next year, we are hoping, I'm putting air quotes, hoping that we're going to see rates somewhere in the high 4s, low 5s.
Okay. So, I mean, historically average 5 to 6% is really should be a comfortable interest rate for us. I feel like what happened is we got super comfortable at 3, right? That anything over 3 was then ridiculous, at least from a buyer perspective. So what happens when I take my buyers and I'm showing them a property, and now here's what's happening, because we're not in COVID, we're not selling in 24 hours in a weekend and 20 offers. We are selling in 60 days, 90 days, 120 days in some cases, depending on market and price point and all those things. So when I go in to make that offer, to be very honest, as a listing agent, right? Because I work both sides I wear different hats. So as a listing agent, I'm not necessarily expecting a full price offer on day 60, 90, or 120. I'm expecting we're going to have some negotiations because this house has now been sitting on the market.
For sure. No,
still a seller's market, right?
No, it's I think it's kind of in both. When you agree, I mean, sometimes depending on the aspect you want to look at it, I think there's a little bit of power in each one.
Yep.
And there's it's crazy the way the mind works. When we start looking at either buyer seller's market, people that have like 2% rates and 3% rates, and they're afraid to sell their house because they're like, oh my God, I'm going to walk into a 7% rate or a 6% rate. Like, it's a whole mentality thing that is difficult right now. So what you're saying right now, as far as like not expecting full price offers, I would probably agree with you, and expecting that negotiation part back and forth, where that was not ever a place in the last 18 months or so.
Right.
This year, at least, that was not a piece.
Yes. So our buyers have been super, when we've been able to educate them on this in the moment, right? We're talking to them about how we're going to make offers, what that should look like. My buyers' immediate response is, okay, let's offer $20,000 off or $30,000 off or $15,000 off. And when I can show them the difference of, let's not ask for that money off, let's ask for the seller to buy down our rate. It's a seller concession. The seller pays it on your behalf. It's coming off of their bottom line. But the difference between taking a $500,000 house and take off $15,000, your payment is negligible. That's not a word. I needed a word.
We'll get it. We'll get that one. It's almost like amortization. I mean, it's just a fun word to say.
I'm not even sure it was a word, but I kind of tried to use it as it is.
We'll let it go.
A little bit. It only changed their payment by like potentially, like $50, $100 a month. Like it's really almost nothing, but they feel good to see we got that $15,000 or $20,000 off. Whereas we can take that very same offer, and instead of saying, I want $15,000 off, I want the seller to buy down my rate for $15,000. And we can change that rate by hundreds of dollars a month in savings.
I mean, it obviously depending on the purchase price and down payment, it's, you know, we're talking what the differences would be with that, but you're exactly right. When you start applying something towards an interest rate rather than a price reduction, you're doing a couple of things. One, you're attacking the pain point directly. Like, what's my monthly payment? Now, keep in mind, when I start talking about, I'm going to sidebar the whole permanent buy down. We can obviously have that conversation. I don't feel like it's a good, I don't think it's relevant in today's, you know, marketplace business. I think it's more of a temporary side is what we're looking at, the temporary buy downs. But the big key to know really quick off the top is the temporary buy down cannot be used to help qualify. You still have to qualify at the higher rate. That's the key. Okay. And that's again, another piece that most folks don't talk about. So you have to qualify based on a full 7% rather than the reduced at 4%. So it doesn't really expand your buying power per se.
That's good. I don't know that I ever realized that. So that's great. That's great information.
Well, yeah, because you got to keep in mind too, let's just say that they never refi.
Right. We get to that third year and we're back at the full payment.
And maybe they don't qualify at that point.
Yeah.
So that's why it's not allowable like that. The other key thing about it too, and I'm not sure exactly the particulars. I think it has something to do with some just accounting pieces, but is that permanent, or excuse me, a temporary buy down, it can only come from a few different places. Unfortunately, the only place that it cannot come from is from the buyer directly. They can't pay for their own temporary buy down.
Right.
It can come from the seller. It can come from the listing agent, right? It can come from the lender, or it can come from the builder.
Okay. It cannot be a gift. It can't be a gift. It can't be a gift, which would be like coming from the buyer, right?
Yeah, it would be like coming from the buyer.
Okay.
It can't come from that form. And the reason being, I'll dig into details and figure out exactly why, because I've been asked about it myself. But that's the only place that it cannot come from.
Okay.
So, but what it does do is it helps folks, you know, that maybe either maybe they're going to get a raise in the next 12 months, right? Their income's going to change. So it allows them to ease into that mortgage payment that they're going to have, right? Because these things have been around forever. And they just haven't been relevant because we've been in a reduced interest rate market for however long that it hasn't been a conversation piece.
Yeah.
You know, so, but it does help them like ease into that payment. And also while they're waiting out that opportunity to refinance the house.
Yeah. And then when you refi, right, people go, oh, well, that's going to cost me money. Well, if you have this 2-1 buy down or 3-2-1 buy down, you actually have money now sitting in account.
Yep.
More than likely, you're going to cover the cost of whatever that refi is, and probably then some, have some money left over.
Exactly. About like, I mean, I'm sure you've refinanced a house before. I mean, heck, I just got done refinancing our house. People think that we were crazy, my wife and I, where we took our 2.75 rate that we had and we traded it in for a 7.25. And people were like, you guys are out of your minds what you're doing. Well, we had a very financially driven strategy behind it for debt consolidation and overall thing, which is a totally another separate piece that would help folks. And I'll share, that's another great video to talk about too, as far as buy up potential and also, you know, consolidation of debt for various reasons. But getting back to it, the temporary buy down is just amazing. So to answer your question you just talked about with a seller or a buyer coming in and offering 20K less than asking, right? Or taking a price reduction or whatever it is to get the house sold, you're not really attacking the big elephant in the room.
Right.
Right. And you just talked about it, $20,000 less on a mortgage. You spread that out over 30 years, it's nothing.
Right. Yeah. It barely affects your monthly payment. Whereas you can buy down this rate and have such, I mean, you can have a whole car payment sitting there at the end of the month, every month, because you've saved so much on the interest.
Yeah. Yeah. And I totally got sidetracked, but you mentioned just a second ago where you talked about the cost to do a refi.
Oh yeah.
Whole crazy tangent, but you mentioned like the escrow account, like, well, we'll use air quotes, so we'll call it an escrow account of that funds to pay for your refi, because whatever's left now, it doesn't accrue interest. It doesn't do any of that stuff inside there. It literally just starts to dwindle.
Yeah.
And so if you did a 3-2-1 and after 36 months there was nothing in there, then you got to pay for a refi. But a refi, you can actually roll the fees for the refi into your loan.
Right.
Obviously, if the equity is there, it's just a case by case basis. But let's just say that you did a 3-2-1 and you refinance in a year. You have 24 months worth of principal and interest sitting in this account that is most likely going to cover all of your refinance.
Yeah. Okay. So last kind of question on this, because I want to make sure we get to this final little detail that I know comes up a lot is, okay, we're looking at, let's say 7% interest rates right now. Let's say we do a 2-1 buy down. So we're at what, 5 and 6 for year 1 and year 2. Is that correct? So at what point during that do we say, okay, here's our marker and here's when we should refinance? What is if you're 1%, so it's 7% today, that's what we're locked in for our long-term, right? Even though we have this little buy down in here for 2 years, what is the number we might be looking for, or that gap in interest rates that we might say we need to refinance when we hit this point?
Well, and so there's two big things I want you to know in this. One, I'm not sure if people know this or not, but there's no limit on how many times you can refinance your house. You can refinance your house as many times as you want.
Yeah.
So if it's waiting for a magic number, okay, if someone has that number in their mind, then it makes sense for them, then do it, right? If the cost to do the refi is going to more than cover, the reduction in payment from the refi is going to more than cover the cost to do it, and it makes financial sense for them, then great. It could be 0.75%. It could be 1%.
Okay.
And the other big thing I want to let y'all know is like most really great lenders, including myself, my hands out there, is we don't just write loans for folks. We don't just help them with the purchase of it. We're in this for like a relationship factor. We don't want to just be their lender just to help them buy a house.
Right.
We maintain and we monitor their loan, not just right now, but to find that sweet spot. And we keep catching back up with them saying, hey, this might be a really good opportunity because we're seeing that rates have gone down 0.75% or 1 or whatever it is. And there's going to be a good pocket to be able to do it. Really great lenders are out there and they're paying attention to what the market's doing. If it does have that little dip and it's an opportunity to refi, let's grab it before it goes up, if it does. But it's probably going to start settling in, like I said, probably later next year into that, high 4, low 5s kind of number, depending on credit and all that, to where that's going to be the big trigger point for everyone to kind of get in and start refinancing their houses.
Yeah.
We're definitely going to hit a refi boom. That's for sure.
Yeah, I know. Real estate's cyclical, and people, we just kind of forget, what we dealt with 3 years, 5 years, 10 years past. We get really comfortable in what's happening. And COVID was so uncomfortable in the real estate market, but we, oddly enough, got comfortable in the fact that that's what our real estate market was. So it has taken us a long time to really almost wake up from that fog. I feel like we were kind of all hanging on for a bit, like a giant roller coaster of, what's next.
It was like an unrealistic bar that was set.
It really
yeah. And a lot of first time home buyers that kind of came in during that bar setting moment, that lasted for a long time. Like, oh, no, it's not going to change. This is awesome. We're going to do great. And we started having conversations. I think it was last September when rates started to go up and the 4 was hit and the 5 and the 6. And oh my gosh, there's a bubble and it's going to pop and all these different things. Well, what do we know about this area, Holly? Like, it is so underbuilt. It
really is. We just kind of keep telling people, well, it's interesting. I'm going to get a little off on a tangent here, and people, if you're still watching, we love you. Otherwise, like, comment, subscribe, reach out to Josh for all your lending questions. But a quick little note, I was looking at a diagram the other day, and we were really talking about, if you bought property in this little DFW Metroplex, kind of the smaller circle of DFW Metroplex 20 years ago, your values today are ridiculous. We're talking land, commercial, residential, doesn't matter what it was. Those people were potentially patient, right? Or they bought and sold in a way that they were able to still take advantage of that equity growth over time. And our bubble got a little bigger, right? People are willing to go a little bit further outside. We've built up, we have a little more land. You just have to find your space. You really have to know and kind of, ask the professionals, ask the lenders, ask the realtors that are in this market every day. where could I buy that I have this potential, right? We don't have a crystal ball, but we do have data. And so if we go a little bit outside that circle, if you're patient, real estate is kind of like the stock market. Usually it's a longer play.
Well, it has to be. I mean, it's the biggest investment anyone's ever going to make in their life, and more than likely, it's not just one house. They're going to, what's the average? Every 5 to 7 years or so, someone moves.
Yeah.
And so needs change, families grow, get smaller, whatever it is. But it's a house is like I like to describe it kind of like an ATM machine. Is you have to be in it for the long game of what it is, because real estate does do that. Rates go up, rates go back down, rates go up, go back down. It's not hey, they go up and they stay up.
Yeah.
Or they go down and they stay down. It just doesn't happen that way.
No, unfortunately, once you get comfortable, it all shifts and changes again. But
there's always an opportunity within a shift though too.
Absolutely. Yeah, absolutely. And, a lot of our sellers right now, or homeowners who don't want to sell, they're taking advantage of that cash equity, kind of like you were talking about. You have cash sitting in your home more than likely if you've owned it more than 2 or 3 years. There's cash sitting there, and people are saying, I don't want the higher interest rate. I don't want to move out. I don't want to do this, but I need this cash. And so there's some ways to access cash and some other opportunities there that we don't talk about all the time, because it's not necessarily in my real estate wheelhouse, right? I want people to buy and sell houses. However, we're here as a resource too. And so when our clients reach out to us and say, hey, here's the bind we're in, or here's the situation we're in, and here's what we want to do, here's what we're looking to do, then we have the opportunity to guide them to awesome resources like yourself. So we can, just help guide them on what is the best for their goals and their motivation.
Yeah, I'll tell you what, Holly, and this is a good one. This is probably a good one to kind of cap it off on, to say that, and for folks that want to come back and check out maybe one of the next episodes, is you just talked about how a cash out refi and having that equity in their home. That might be that, you buy and sell, right? And then that's more like in my wheelhouse. But there's really great information that I've taught recently that shows like using something like that for a move up potential. Someone that actually has say a $500,000 house, you have your blended interest rates, your whole household that everyone neglects to listen to and think about with credit cards and cars and all the things. They can potentially get into an $800,000 or $900,000 house, depending on what their debts look like, for maybe they might even be saving money from what they're paying right now overall in their house by using that equity and doing a move up scenario. So that might be something to check out in one of a next discussion we have. Yeah,
let's do it. We'll plan that for next time. Well, Josh, thank you so much for your time today. I really appreciate you. We have all your information down below. So if anybody just has quick questions, I know they can shoot you an email, and I know you will get back to them, because my clients and friends and family know that I only refer people that I personally work with. And so I'm letting everybody on my channel know Josh is awesome, and you can trust him to help you out. So
I appreciate you.
Yeah, we'll have you back on again. And thank you so much for your time, Josh.
It was my pleasure. Thanks, Ms. Holly.
Awesome. Bye.
See you.